Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. When it comes to Wall Street analysts, most investors give them a really bad rap, and rightfully so. Many analysts simply go with the flow, and as soon as a stock goes crashing down, they re-rate their price target to something lower. As soon as it starts to rise, regardless of the fundamentals changing, you guessed it, they would probably increase that price target. And actually, we could look at a stock like Salesforce, which I did a bunch of videos earlier in the year. And over on FinChat, if you just go to the estimates tab and you simply look at price targets, you're actually able to look at the historical price targets and the revisions and that type of stuff. And you could see as the stock price dipped from 270 to 218, literally dropping 20% in a day, guess what happened to the price targets? They went from 330 to 300. So roughly a 10% revision across the board, but nonetheless, a lot of revisions going at the same time. And then now that the stock price has risen over the past couple quarters, the price targets have also been revised to match the rising stock price. It almost seems like most of these analysts are actually putting out moving goal lines as opposed to actual price targets based off fundamentals and real research. Now, with that being said, it is true, most analysts, 99% of them, are absolutely horrible. They don't know what they're doing, and they're just simply trying to make a career out of basically going with the herd. With that being said, there's a handful of analysts that are able to reliably beat the market and actually provide valuable insights. And based off the revisions and their price targets and that type of stuff, they're actually able to provide alpha to the larger investment community. One of those individuals is Mark Mahaney of Evercore. Mark Mahaney is a senior managing director and the head of Evercore ISI's internet research team, which immediately kind of dates the cohort of investor he is. And he's been doing that for 25 years consistently. Based off this research company, he was recognized as the top 3 ranked analyst for 18 years, and he was ranked as number 1 for 6 years. And actually, this isn't a cherry-picked metric. If you literally go on to TipRanks, which is kind of known as being like the analyst website or whatever, if you look on TipRanks, you could see that he ranks 36 out of 9,000 Wall Street analysts. He's provided an average return of 30%, and this isn't just a couple years of ratings. He has a track record going back to 2009. And TipRanks puts a little note at the bottom here saying that had you traded based off of his ratings over the past, roughly 14, 15 years, you would have had roughly a 63% return. Excuse me, I'm reading that wrong. You would have had 63% of your transactions being positive and generating a profit, and then you would have had a 30% average return across all of those, assuming obviously you've had even investments and that type of stuff. But anyways, you guys get the point here. This guy's legit. He's the top of the top. He's in the top 3%, top 0.4% or something like that. And actually, he frequently goes on to CNBC to talk about his favorite stocks or his favorite investments at that moment. And I'm going to let you guys be the judge of this yourselves, but to me, it just seems like a very rational investor looking at the fundamentals, looking at the real underlying secular growth with some of these businesses. And so as of a couple days ago, he went on to CNBC one more time and he gave us 2 different stock picks that he's currently looking at, 2 of his investments that he's continuously been kind of pounding the table on over the past 2 years. And so we're going to see what he thinks, what his thoughts are at the moment. Also, the clip is slightly sped up just for the sake of time.
Right now to talk some internet stocks ahead of the holidays here. Mark Mahaney, Evercore ISI, head of internet research. Good morning to you, Mark. You know, we've been talking about how basically the entire market has just to continue to fly. And the question, of course, is how much more does it have to fly? Whether you think a pullback is in the offing, and if you don't want to market time it exactly, what's the right move here?
Okay, well, you're right, Andrew, that we've had a pretty big rally in especially the highest quality internet names. There's very little dislocation now. We've got stocks like Netflix and Meta and Spotify that are close to all-time highs or have been knocking on all-time highs in the last couple of weeks. So there's not that many new opportunities in there. We continue to like Amazon for one of the reasons you already talked about earlier on the show, which is what I think is going to be an inflection point in ad revenue. And then we particularly like Uber here. It's actually one of the few, maybe the only high-quality internet stock that's dislocated. So those would be our 2 top picks going into the end of the year.
When you say Uber is dislocated, let's look at it right there. You're saying it's come down from its high. Is that what you're suggesting?
Yeah, and there's 2 reasons. The stock's corrected something like 20%. It's dislocated for 2 reasons. These concerns over what happens to Uber in the robo-taxi world. And then there's the concern over this last quarter, the print. We had some deceleration in what they call the mobility bookings, the rideshare bookings. and there's a concern that that's going to continue on into next year. I think both of those concerns are overstated. I'm taking the other side. That's why it's our top pick. I think as the largest demand aggregator for ride sharing, I think Uber is going to be a positive derivative. I think it's going to be a winner off of robo taxis. I think we're going to see more Waymo business deals with Uber that are consistent with what they've already announced in cities like Atlanta and in Austin. And then on the mobility side, I actually think that the comps get easier going into next year. I think the product continues to improve, things like Uber for Business, Uber for Teens. So I think the growth rates for Uber's mobility business can actually stabilize going into next year. It'll probably stay close to 20%. I think that's good enough to take the stock materially higher from here.
Okay, so he said a bunch of different things there. So his top two picks seems to be Amazon and Uber, which are two businesses that, I mean, Amazon I currently own. It makes up 30% of my portfolio. And actually Uber I've owned in the past. It was a 2% kind of watcher position, if you will. And straight up from the video I made talking about how I entered into Uber, I managed the expectation up front. I said, it's a watcher position. It might not be in the portfolio a month from now. And so since then, I've sold it. I ended up putting the funds into Google below like 150-ish. But anyways, it's interesting what Mark brought up there. First and foremost, Amazon, which keeps soaring every single day, but he mentioned that the advertising revenue reacceleration is what he's looking for there. He thinks that's going to continue to be a highlight for that business. No disagreements there. Amazon is just firing off on all cylinders. It's a wonderful, wonderful business. The mixture of cloud advertising and the old third-party business kind of being the higher margin parts of the business, that should naturally over time drive massive profitability, margin expansion, all that good stuff. And then on top of that, you're seeing a reacceleration in AWS growth, right? So we've seen over the past year going from like 10% revenue growth to I think around 20% revenue growth. Again, very, very impressive business, impressive stuff. I'm sure you guys are well caught up on the Amazon story. Now, in terms of Uber, which is a little bit more of a niche pick, he says that is greatly discounted relative to where they peg the fair value to be, and I completely agree with that. Actually, last night I had some free time to kind of run the numbers on this, and I'll show you the spreadsheet after this, but I was basically looking at it and I'm thinking, okay, with relatively fair to maybe even conservative estimates, right, where it was below the analyst average estimates, and on top of that below the guidance that Uber actually gave us, I was landing at a 16% stock CAGR in the light blue here. If it were to trade at a 7% free cash flow yield, a 7% free cash flow yield, that's like on par with like telecoms, like T-Mobile and AT&T, and that, like, those are the level of the companies that like basically have no growth, have balance sheets that are just eye-watering in terms of the amount of debt that those companies have, unbelievably capital intensive, essentially no differentiation in terms of the products that is provided. It doesn't really matter if you go with AT&T or if you go to Verizon. They're going to give you the same cell service. Like, it might be slightly faster. You might get a special deal here because it's a family deal, whatever. At the end of the day, like, it's a commodity product that they're selling. That's the level of businesses that are selling at a 7% free cash flow yield in the stock market. Not Uber, with a wide network effect. It has a massive secular tailwind of disrupting taxis just on a base level. And they haven't even expanded into a lot of geographies. They're basically only in developed markets, and like Eastern Europe is still a big avenue for them to grow into. Like all these different great qualities about this business. And I was getting a 16% stock CAGR, this for the next 3 years, if it were to trade at a 7% free cash flow yield, right? So I kind of agree with him saying that Uber is massively discounted. And part of it does have to do with the fact that people are scared of the robo-taxi version 13, supposedly right around the corner. And then he did mention something about the gross bookings print being slightly off. I personally didn't know about this, so actually we'll kind of check it out together here. This website we're using, by the way, is finchat.io. It is the only sort of sponsorship or affiliate that I've taken on the channel, and there's a very good reason for that. So if we simply go and take a look at Uber, and then we go down here into the segment and KPIs, we could actually look at company-specific metrics for hundreds and hundreds of various different companies. And so this is the gross bookings that he was specifically talking about. And so we're on the annual view here, but if we go down into the quarterly view, and then we simply toggle on the percentage change to see what Mark was talking about. I'm actually going to switch these around just so the colors change. And he would be right. So it went from roughly a 19% year-on-year growth down to a 16% year-on-year growth. By the way, gross bookings is kind of what it sounds like. It's not the actual percentage of money that Uber keeps. So in, for example, a $10 transaction with Uber, they would keep roughly on average about 30% of that. And so they would recognize that as revenue, but then it's actually the headline $10 number. So 7 of it goes to the restaurant or the Uber driver, and then Uber actually keeps 3% of it. That would be the revenue. The $10 would be their gross bookings. That's the amount of money that was transacted on the Uber platform as a whole. And so this is kind of like a proxy for Uber's future revenue. Like if they don't actually give you guidance for revenue, they give you guidance for gross bookings. And it's a proxy for Uber's revenue because realistically in the long term, actually we could look at that to kind of demonstrate that as well. But if we chuck on the take rate, the total take rate across Uber's business, you could see it's kind of like post-COVID, they bumped it up to just shy of 30%. And then since like mid 2022 or so, it's actually kind of stagnated, been flat, been down a little bit on some quarters. Again, depends on like in that particular quarter, were they expanding into a new country, taking a lower take rate, all that type of stuff, right? So it's kind of hovered around like the high 20s-ish range. But anyways, going back to what Mark Mahaney said, it actually deaccelerated down to quite literally the slowest. Oh no, actually we had this one off quarter in Q2 2023. So it's almost the slowest growth across the business ever, right? And so to their point, or to Mark Mahaney's point, like, yeah, that is probably a decent bit worrisome of like, oh, maybe the expectations baked into Uber's future growth, partly driven from the guidance that they gave us, maybe that's too optimistic. Maybe they're going to permanently slow down into slower growth. But to maybe kind of argue the other side of that coin, if you toggle on the revenue growth, you might notice that it actually accelerated in the same quarter to 20%. So it's a little bit weird to kind of see the differential of those two. It means that the take rate went up, but obviously that's not going to be sustainable going out into the future because there's only so much that Uber could increase their take rate by. Anyways, let's go back to what he has to say.
Materially higher is what?
Oh, 30-40% upside. I mean, you put 25 times free cash flow on an Uber, and you could easily get 50% upside from here. It's a high quality asset. Free cash flow margins are ramping, and I think you'll see them aggressively start leaning into buying back stock. You got all the makings here of a really nice outpacing stock.
How do you think about Lyft, by the way, in all of this? They've actually done quite well recently.
The stock's done well. They've started to execute a little bit better. If Uber was at an all-time high and trading at a 25 times free cash flow multiple, I'd probably look and lean into Lyft. But for now, I can sort of look at the largest, best situated, most globally diversified, most product diversified, gig economy play. That's Uber, and I can buy it at what I think is a really great discount. I don't see the great need to step into Lyft.
And then very quick note on him saying that there's 30 to 40% possible upside with Uber. Again, I agree with this. I'll show you on my spreadsheet how I kind of arrive at those numbers as well. And he also talked about something very interesting. Again, I think a lot of people have simply just not looked at the Uber financials in like a year or even a couple quarters, and they just kind of write it off as like, oh, it's turning the corner on profitability. They're not really there yet. And I would like to show you, again, over on finchat.io, which I absolutely love and use every single day, Uber is incredibly, incredibly profitable. They're actually printing, let me zoom in here a little bit more so you guys could see better. They're printing 19% of net revenues into free cash flow. And they've been ramping that for the past, give or take, 8 quarters, from borderline unprofitable to they are unprofitable, having a couple quarters where they are producing some level of free cash flow. They've scaled the business and cut costs and just done an absolutely wonderful job executing on efficiencies within their business. And they're now printing just shy of 20% in free cash flow margin. To give you an idea, which isn't really that fair of a comparison because, Google's free cash flows are kind of out of whack at the moment with the investment cycle they're in. But technically, the comparison stands at the moment. Google is doing roughly 20% free cash flow margins right now. The same quarter that Uber just reported, Google is doing the exact. So people kind of point to Google as this like very high margin, highly profitable, it just spits out cash type business. And yet they fail to realize that Uber is literally matching that right now. And again, I'm going to point out that like this is on depressed this is on depressed free cash flow margins for Google. But I mean, like even at their peak, they weren't like significantly higher. It was at 30%, right? And actually, maybe we should just chuck an average on. I would assume like they average they average about like a 21% over the past 5 years. And in the long term, over the past give or take decade, they've averaged about a 22% free cash flow margin. So actually, it's a very fair comparison. Uber today is at the identical free cash flow margin, or maybe just under what Google has been at over the past decade. And yet many people will just turn a blind eye to that. They'll call Uber the unprofitable company, wasteful company, so on and so forth. And at last, the spreadsheet that I've built, it looks more complicated than it is, I promise you. But basically, you only really have to worry about like these kind of 5 boxes over here. And so the first 2 in green, these are the actual numbers from Uber themselves. I got both these numbers again from finchat.io. And so this is the actual amount of free cash flow that Uber has produced over the past 12 months. And this is the actual amount of revenue that Uber has produced in, again, the past 12 months. Now, these three in the yellow are projections that I'm putting into the spreadsheet. I think that over the next 3 years, as highlighted by the beginning year over here, 2024 and 2027, over the next 3 years, I think Uber can average about a 0.5% buyback across the 3 years. And then on top of that, actually, I don't think revenue is going to be 18%. I think it will be conservatively around 14% revenue CAGR for the next 3 years. Where do I get that number from? If we jump back over to FinChat and then we pull up Uber's financials one last time, we could go here to the financials tab. And right here, we have the total revenues percentage change. Now this shows it to us in the past, but if we simply drag this out so that we could see the analyst projections, you could see that for the next 3 years, Uber's projected to do 17, 16, and 15%. And actually this kind of lines up well with what Uber themselves had said. So Uber themselves, they've guided for 20% gross bookings growth for the next 3 years. And then let's just say the take rate by some miracle goes down over that time. That means that you're conservatively able to grow at 14% for the next however many years, for the next 3 years, excuse me. And then free cash flow margins. So we just looked at it. The current free cash flow margins is 19%. I'm going to be extremely conservative with this. I'm very easily, you could bump this up to 23, 24%, and it would probably be very achievable, especially for Uber, but I'm going to only put it at 21%. It grows only 2% in the next 3 years. Again, very conservative estimate on that front. And then if you scroll down here, this is the important part of the spreadsheet. What you're looking at here is what I like to call the free cash flow yield distribution. So what this tells us is that based on these inputs that we put up here, if Uber were to, for example, trade at a 4% free cash flow yield in the year 2027, the stock price would be $157 per share. And then based off that stock price, it would mean that it's growing at 29% per year. Because today you could go out and buy as many shares as you want for $73. And so the difference of those two is 29% per year. And then by some miracle, if it trades at a 3% free cash flow yield, which I think is unbelievably unlikely, that means it would be a $210 stock. That means you're making 42% per year on Uber stock. And so the interesting thing I want to point to is that even if Uber trades at a 6% free cash flow yield on, again, pretty conservative estimates, like we didn't really have to move the sky in order to arrive at these numbers up here. If Uber is able to achieve those numbers, or even perhaps achieve a little bit better, you're looking at a floor of 13% stock price appreciation per year if it were to trade at a 6% free cash flow yield. Again, I'm going to remind you, some of the businesses that trade in the 6% free cash flow yield land is car companies and oil and gas companies. Some of these just straight up inferior business models where it's commoditized, lots of competition, and 16 times cash flow. Like Ulta Beauty trades at 16 times cash flow. Like it's a retailer, not a world-renowned tech company, massive network effects across tens and tens of geographies, right? Like, are you starting to kind of get the picture of like why this is just such an incredible opportunity? And so let's just go with a very slightly more bullish stance. Let's say they do about a 15% revenue CAGR, and then they're able to go to, I don't know, 22.5% free cash flow margin. And then they start doing a 1% buyback. Again, like decently conservative. You just heard Mark Mahaney talk about how they're going to be able to start ramping up that buyback. All of a sudden, you're looking at like a 5% free cash flow yield situation. That's like a 24% stock CAGR. And so you're probably wondering like, oh, where does the price to free cash flow sit at currently? Currently, they're at a just shy of 4% free cash flow yield, right? So even if the multiple goes down a little bit, right? So the free cash flow yield goes up, the multiple's going down, you're still looking at like a 24% stock CAGR. So like realistically, however you kind of run these numbers, you're baking in a lot of margin of safety simply off the back that this company is going to have a lot of growth, to be able to do, I don't know, a moderate amount of buybacks, and actually able to raise their free cash flow margins even a little bit more. And ladies and gentlemen, that is the current state of Uber. I think personally it's deeply undervalued. And actually, if you go over to my other spreadsheet, this is the original one that I typically include in the videos. Long story short, we're taking the current price to free cash flow, and then we're dividing it by the projected amount of growth for those free cash flows for the next couple of years. And so Uber, by far, out of the entire spreadsheet, ranks as the most undervalued across all these different names you can see on your screen now. Of course, ASML is the stock that I've like recently been buying personally, just purely off the back of like it has a very wide moat. But again, that's like a little bit of a frothy growth estimate on ASML as well. Like Uber could very easily clear 25%. I think ASML, it's a little bit on the higher side in terms of growth for that business, right? With that being said, thank you very much for watching. You've seen me use FinChat all video long. It's the top link in the description down below. And if you're interested to try the full functionality version of the website, I believe, depending on when you're watching this, there might be still a limited time Black Friday sale for 25% off of the premium and pro plans. It's a website that I use every single day and I absolutely love using it. It saves me hours of time. And it's the only affiliate or sponsorship or anything like that that I've taken on the channel. And there's a very good reason for that. I just absolutely love the software and I genuinely use it. Thank you very much for watching. Be sure to subscribe because it costs you nothing. Have a great day.